Welcome to another episode of My Private Network. I'm Bob Simpson, your host, and today we're diving into the world of real estate lending and private debt investments. And you know what? There's no better person to guide us through this than John Hutchinson, CEO, Trez Capital, joining us today from sunny Grand Prairie, Texas. Ever consider how real estate-backed loans can generate consistent income and how private debt investments can offer stability in volatile markets? Well, today's your lucky day. With over $4 billion, I think $4.4 billion, I think, John, is that what you said to me?
$5.5 billion.
Whoa, $5.5 billion in assets under management. Trez Capital stands as a leader in real estate financing, especially across booming markets like the U.S. Sunbelt. Under John's leadership, Trez Capital has earned a reputation for providing high yield returns while maintaining a laser focus on capital preservation, a rare combination in today's unpredictable market. In this episode, we'll explore some of the more pressing questions around real estate lending. What's the thesis behind Trez's investment strategy? Why are residential projects still such a hot ticket? And how does today's environment compare to the 2008 financial crisis? John will also share insights on risk mitigation, why some lenders steer clear of things like lot development loans, and which are some cities and states that are his primary focus. So I think that's a pretty good summary of what we're going to talk about here today. Now, if that's not enough, we're going to dig into why repeat borrowers flock back to Trez and why Trez is venturing beyond debt and into some equity investing. So John, how's it going?
It's going pretty well.
Pretty well. Yeah. So just, you can hear John's accent a bit. John's an almost Canadian. You can probably tell by his accent that he grew up in Buffalo, by the tone of his voice. And he's still struggling with what happened to the Bills in the Week 5 loss to the Texans. It was a little better last week, John, but it's still too close to win against the Jets. Did you think?
Well, I'm still, Bob, I'm still struggling with the 4 Super Bowls in a row that we lost back in the 90s. So I'm a long-suffering Buffalo Bills fan.
Yeah, what are the worst words in the vocabulary of a Buffalo Bills fan?
Wide right.
It's wide left. Yeah, it's wide right. Yeah.
I think it's wide right.
Yeah.
I remember that.
Yeah, I bet you do. Yeah, I think we all do because, living here in Ontario, we're pretty much mostly Bills fans. So up against the clock, let's dig in. I mentioned one of the things that we're going to talk about today, John, is the thesis. What's the thesis underlying Trez's investment strategy?
Well, Bob, it's relatively simple. It's about growth. And our thesis is that growth in population and growth in jobs presents opportunity in real estate, particularly for residential real estate. It's as simple as people have to have somewhere to live. And when they're moving from other places in the country, usually because of a job or sometimes family reasons, they need a place to live. They need an apartment or they need a house. And that's our primary business, is financing or investing in residential properties. And that's our fundamental thesis. And the growth, it's primarily beneficial to residential, but it's also beneficial to retail and other things, because if people are moving and areas are growing, people need a place to shop. They need a place to eat. They need self-storage facilities to store things in. So it's all driven, in our opinion, by growth. And that's what we seek out, is opportunities in growth areas.
Yeah, John, I think a lot of people in investing, they fail to look at one of the most important factors in investing, and that's demographics, right?
That's right.
Sounds like you're a demographic follower.
We are very data-driven. We subscribe to a lot of the best market research companies in the country. John Burns is one of them. Zelman and Associates is another. Zonda. We've got a whole plethora of research that we get sometimes every day. Burns publishes something virtually every day. So we're all about demographics. Where are the people going? How many houses are being built in a particular market? What is the supply of vacant lots? What are the supply of lots in the pipeline? All that data is there, You just have to expend the time and energy to research it and find the information. And one thing that we're particularly careful about is not overgeneralizing things. You'll hear, well, house sales in the United States are in decline or whatever, and that may be true on a national basis, but it isn't necessarily true of every market. So we look at every market we do business in, and we don't just look at the top line numbers and say, well, it's slowing down in a particular area, or it's picking up in a particular area. We want to look at we look within the submarket of the major metropolitan areas. For example, in Dallas, there's about 90 different submarkets that you can build houses in or apartments or whatever. So we look at particular submarkets to determine where we're going to invest our funds, not just in Dallas, but in other cities. That applies as well.
Yeah, so it's sort of like watching the U.S. election and studying the swing states. The swing states are probably states that, in your vocabulary, a swing state is maybe where the population flow is really positive, and you're getting things like U-Haul traffic going in that direction as opposed to going the other direction.
The U-Haul traffic is one of the items that is followed. When it costs so much money to take something from U-Haul from California to Texas, that's a sign of people moving to Texas. And then when they almost pay you money to take it back from Texas to California, that is a sign that very few people want to move to California. So we have had for quite a while a great, what I call another great migration. The U.S. has had several great migrations. The 19th century was one. After World War II was another, and now we're undergoing another great migration as people leave California, New York, Illinois, New Jersey, and move to the southern states, the Carolinas, Georgia, Florida, Texas, Arizona. You're talking about thousands and thousands of people. And those people, like I said, they need a place to live. They need a place to shop. They need a place to store things. And there's various things that are driven by that population growth.
Yeah, I think it's pretty amazing that people would even consider moving from New Jersey to the Sun Belt. Don't you?
No, actually, I wouldn't. Having moved from Buffalo to Dallas in the late 70s, I've seen what goes on in a lot of the northern cities as they've declined, and then the southern cities as they've boomed over that period of time. It's really quite incredible.
Yeah. It might be nicer living in Dallas than listening to Irv Weinstein talk about 6 feet of snow and fire in Lackawanna. Right?
Yes, that is. Yes, it is. I don't miss the winters down here in Texas.
I bet you don't. Yeah. So if you look at products in your lineup there, what are some of the preferred asset types that you like to look at?
Well, as you said, I think I've said, we do a lot of lot development projects where lots are developed for home builders to build houses on. We also do, although this has slowed down quite a bit due to the current economics of it with high interest rates and whatnot. We have typically done a lot of multifamily construction loans. We also like to do industrial, and we do some retail. We don't do any office building loans. No. We haven't done any, and don't have any intention of doing any. It's a market that is very troubled right now, and it's not one that we were ever attracted to. So those are our primary areas. But we're opportunistic. We do some other things every once in a while, but that's our core business, and that's where we like to invest our investors' money, because we're very comfortable with those product lines.
Yeah, and you're very strategic too. It's not like you're multi-weighting the different asset types. That you look at where you believe there are positive factors involved, and they ignore the ones where negative factors like office.
That's absolutely correct. We started making some hotel loans a few years ago on limited service hotels, and we did a very thorough analysis of what it takes to be successful in doing that before we embarked on doing it. And then we made probably 8 or 9 loans, and they all went fine. And but we spent a lot of time studying an area before we'll do anything in that particular area. We made a couple of RV park loans, and we did a lot of research in that before we did those loans, and they're fine. But we look for we try to be opportunistic. We do not have limitations placed upon us by any government regulations like the banks do in the United States, and I'm sure in Canada as well. And right now, the banks have a lot of limitations on them, and that's good for us because it means they can't do as many loans. And in the lot development world, the regional banks were competition, and now they're really not because they have the government is limiting what they can do and how many real estate loans they can make and whatnot. So that opens up opportunities for us.
Yeah. Now, when you talk about lot development, just share with us a bit what you're talking about.
Yes, lot development is a very, very big business in the United States because you can't build a house unless you have a lot to build it on. And there are hundreds of thousands of homes built each year in the United States, Texas being the one with the most homes built in a particular year. So a developer will come to us and want to buy a tract of land. We will, once the land is entitled, we don't loan on speculative land. We only loan on land that's zoned and can be developed into whatever the developer's plan is. So we once that is zoned, the builders who are going to buy the lots sign contracts to buy the lots. And when they do that, this is the unique feature of lot development financing and lot development investment. The builders will put up significant amounts of earnest money to secure their obligation to buy the lots. That is additional equity that goes into the project. The developer puts in equity, the builders put in earnest money, which is, as far as we're concerned, is equity because it's at risk in the project. And so when we make a loan, we've got two parties that have skin in the game. One is the developer, the other is the builder. And the builders will put we closed a loan recently where the builders had $42 million in earnest money in the project. And it's it makes us from a risk mitigation standpoint, it's very important because that builder who has put in all that money not only has that at risk, but has their business plan at risk if they don't get the lots delivered to them to build the houses that they're planning on building and selling, and would obviously affect their returns if they don't have those lots available. So that is a very important thing to the builder. So that is the big component that's very different. No other real estate investments have the earnest money component that exists in lot development. So that is something very important to us as a lender, and also it's important to the developer because that builder's committed to the project.
Yeah, it's pretty hard to walk away from $42 million.
Yep, and it gives that builder skin in the game, and they are as interested in getting those lots completed on budget as we are. So it's a very unique. It is one thing about lot development also that's very different is you don't evaluate a project based on cap rates. You don't the projects aren't transacted based on cap rates. So cap rates don't have anything to do with lot development. And so you can sit around all day and argue about cap rates and where cap rates are going to go and what they should be and all that. It's meaningless for lot development. Interest rates are important. IRR is important, but not cap rates.
Yeah, one thing that I've been down on a couple of your tours down in Texas, and you put the builders right up on stage to tell their story and how what they're all about. But you have really tight relationships with many of those people, don't you?
Oh yeah, we have very strong relationships with the builders that are in the projects and the developers. And one thing we're proud of is our percentage of repeat business. About 75% of our loans are made to borrowers that we've already done business with. We're always looking to add new borrowers, but we focus a lot of attention on the borrowers that have done business with us before. because obviously we've underwritten them, they've performed, or we wouldn't make them another loan. And so it gives us a great deal of comfort from a risk mitigation standpoint that these are people that we've done business with and we have a reason to trust them.
Yeah. Now, one of the, a big word that comes up in the world of investing is bubbles, right? Your focus is on investment in residential projects. Everybody remembers what went on back in 2008 and the conditions that led to the great financial crisis. How are things different today than they were back in 2008?
Well, Bob, that's a good question, and it's one that a lot of people they ask, and a lot of people suffered some scars from those days. I was in the home building business during the Great Recession, and I saw what happened, and I saw why it happened. The lending was far too loose. There was an effort to create what was called an ownership society, and both political parties were involved in this. You can't blame it on the Democrats, you can't blame it on the Republicans. They were all involved, and it was well intentioned. Let's create an ownership society. In their life, they'll have a chance to build up some asset. It'll be good for families. I mean, there's a lot of reasons why you wanted that. But the fact was, there are people that just weren't qualified to buy homes. The whole market on the front end, in terms of on the front end, it got too loose with lending to developers. On the back end, it got too loose for home buyers. People were buying homes that should never have been able to buy a home. They didn't have the credit. They didn't have the savings. As soon as their car broke down, they couldn't pay their mortgage payment because they had to make their car repair bill. So it was too many houses were built, and they were built for people in many cases who could not afford to keep the house once there was any setback in their life, and that resulted in massive foreclosures, reduction in value of homes, and in a lot of losses. But that doesn't exist today. On both ends of the pipeline, it's much tighter. The lenders, let's say the banks, they're not loaning a high percentage on non-recourse loans. If you want a non-recourse loan, the bank today probably won't loan you more than 60%. So you got a 40% equity gap that needs to be filled. Some of that's good in lot development. Some will be filled by the builders. The rest will have to be filled by the developer. And so you have it's tighter on the front end, and it's much tighter at the consumer end because it's hard to get a mortgage today. Their mortgages are underwritten strictly, and they are very demanding, particularly if you're self-employed. There was a lot of fraud that went on, and a lot of people were allowed to buy houses based on fraudulent statements about how much money they made. In many cases, loans were made to people who just said, "Well, I make $10,000 a month," and nobody checked. The underwriting was very lax, if it existed at all in many cases, and that does not exist today. If you're self-employed and you say you make $10,000 a month, you got to be able to prove it, or you're not going to get a loan. So that's very different than what it was leading up to the Great Recession. The system is tighter, it's more disciplined, and we're confident that what caused the Great Recession isn't going to happen again. They've really tightened things up, and we're confident that situation is behind us, and our government has put some things in place that are going to prevent that from happening.
Yeah, so it's sort of not like Oprah. You get a home, you get a home, you get a home. Right. It's much tougher than that today. So it is, and you've been touching a fair bit on the mitigation of risk. When you look at putting out a loan, an investment, what do you do to keep risk levels contained?
Well, first of all, we get to know the borrower very, very closely. We do background checks on the borrower. We do some inquiries in the market about the borrower, about the borrower's quality as a person, the quality as a developer. We know a lot of people throughout the country, so we can check people out, even though it's not somebody in Dallas. And so we do that. We do some research personally. We get, like I said, we get a serious background check, and then we, as our due diligence on the project, we do a market. We have a market study performed by a market research company. We will have our consulting engineers review the budget to make sure that the project can be developed for the amount that's in the budget, and the budget is reasonable. We usually know the builders pretty well about what the builder qualified to build this type of product. Some builders can build houses at the higher end of the price spectrum, but not the lower end, and vice versa. So we want the builder to be qualified. We want the builder to have good operations, because if they're not a good operator, then they can screw up a deal that would otherwise be successful if in the hands of a good operator. So we approve the builders. The developer suggests who the builders are, but sometimes we tell the developer we won't loan if you have that builder as in your project. So that's what we do on the front end, and then as the project progresses and there's draws made on the loan as work is done, we send a consulting engineer out to the field to review the work, make sure the work has been done, and that the draw is supported by actual work in the field. We don't want our borrower getting ahead of us and drawing more money than work has been completed. And that's what we do through the life of the loan to stay on top of things. We have a really good asset management team that stays on top of all of our loans during their lives, so we can tell if a loan's starting to look like it might start to have problems going over budget or whatever. Then we address it early on, and generally have the developer put more money in to fill up any gaps caused by cost overruns.
So the way you describe it, and from what I've seen in some of the seminars and things that I've attended, is with that 75% recurring group, it's almost like you're a partner in the deal as opposed to the lender.
We take that approach philosophically, but not legally. We like to speak. We like to talk in terms of an interest that we have, a mutual interest. We're very careful about not calling ourselves partners because we don't want the legal ramifications to go along with that. But we do philosophically look at things that way, and our borrowers do as well. And we help our borrowers in some respects sometimes to give them information about who they should be dealing with for one thing or another. Who's a good builder, who isn't. It depends on various circumstances. But yes, we are not antagonistic towards our borrowers, which I think some lenders are. We're firm but fair, and we expect them to do what they're obligated to do, what they've agreed to do. But we don't go out of our way to nickel and dime them, and like some lenders will do, which just aggravates the borrowers. And so we build a relationship through many ways, and that's why we not only have repeat borrowers, we get a lot of referrals from borrowers who refer their developer friend to us.
Yeah, somebody they're working with and
right.
done the work in the past, so it's a good referral. Now, are people lining up, John, on lot development projects today, or are there a lot of lenders who are avoiding this kind of work?
Well, yeah, lot development is I may have said earlier today, is a area of real estate lending that a lot of lenders don't enter into because it is different. It is analysis of it is not related to cap rates. You can't just put a financial statement together, come up with some NOI, and then multiply it times a cap rate. That's not the way it works. So a lot of lenders don't get involved in it, and that's fine with us. There are it's not like we're the only one in this business. Believe me, there are a lot of good lenders that do it, but it's not as many that do retail loans or office loans or some other things that are more middle of the road. So that's but it is a it's got its idiosyncrasies by and that does keep some people out of the business.
Yeah, good to be a specialist in a specific
Right.
area.
Right.
Yeah. No, we kind of hear the broad term Sun Belt.
Mm-hmm.
If we look at where your focus is today, because you are strategic, where is your city-state focus? What's your primary focus today?
Well, our focus is, well, in many cases, it's called the Smile States. You might have heard that term. It's,
Mm-hmm.
from the Carolinas around the southeast through the south to the southwest, from the Carolinas to Arizona is our primary focus. We don't do business in California unless it's a very, very special situation. California is just too difficult. We do a little bit of business up in the Pacific Northwest, but they've been bitten by the California bug. They're a little difficult to do business too, so we don't do much up there. Although we do like Utah, we do like Idaho, but our primary business is the Carolinas, Georgia, Florida, Texas, Arizona, and Nevada are the so-called Smile States, and that's
Mm-hmm.
where we like to focus our attention. We will go outside of that if we have done business in Minneapolis. We've done business in some other northern cities where a borrower that we do business with in our primary states goes up to Minneapolis or something to do a project, and we like the project and we know the borrower, so we'll occasionally do something out of our core,
Mm-hmm. Yep.
but we don't solicit business typically in those other markets.
Yeah. So Trez is really known as a lender, but
Mm-hmm.
you sponsor equity investments as well as debt. Why do you do that? What kind of work do you do on the equity side?
Well, we do about 8 or 9 years ago. Morley Green, our founder, and I decided that we were meeting so many people, and we were seeing so many opportunities that we wanted to bring some of those opportunities to our investors. So we started doing what we call TOFs, Tribes Opportunity Funds, and we're in the midst of closing TOF 8 right now.
Mm-hmm.
So we partner with developers, and our primary business, is, as you might suspect, is related to residential. We've done a number of multifamily projects that we've invested equity, and we have done a number of lot development projects where we have invested equity. We do not loan money on a project that we have equity involved. Obviously, conflict there. We've done 25 different partnerships with Hines, which is one of the largest developers in the world. They have
Mm-hmm.
operations all over the world, and that's spelled Hines. It's not the ketchup people. And they've been a partner with us on 25 projects. They're the developer. We're the financial partner. We look out for our investors' interest, and we have approval rights on all major decisions. And Hines puts in half the equity, and we put in half the equity, and we go forward together. It's been a great relationship. We've been doing business with them since 2012. We have another company that Thompson Realty that we've done 10 multifamily projects with, and I've known that company since back in the middle '80s, and we've enjoyed a great relationship with them. And we have some relationships with a few other developers, but those are our primary relationships that we've invested in through the TOFs. And the one that we just closing, TOF 8, is entirely lot development. There's no other assets in it other than lot development projects, and we have 2 projects in Virginia, 3 projects in Charlotte, North Carolina, 1 in Austin, 1 in Florida, and 1 in Phoenix. And Hines is our partner on 4 of them, and then we have another group that we do business with in Charlotte. We're going to do 3 or 4 projects with them. So we're very excited about that. I think we just raised $45 million for that fund, TOF 8, and we're about to do our first closing with investors.
Yeah, and I've met Rob Hines. He's a lovely man.
Yeah.
You don't know what it's like when something's going sideways and you talk to the same guy, but on the surface he seems nice.
Well, they're good. They're quality firms.
Yeah. Now, from an investor point of view, if we look at the lending side versus the equity side,
Hmm.
um, what are, as you look out over the next 2 to 3 years, what kind of returns would you anticipate for people on the debt side versus the equity side?
Well, let me. I didn't fully answer one of your questions. You asked me if people are lining up to borrow money for lot development, I believe. And I don't think I answered your
Mm-hmm.
question. That is a very high demand area. Right now,
Mm-hmm.
as I think I've said, we're not doing much in multifamily because multifamily is overbuilt in most submarkets right now, and the economics are difficult to make it work with interest rates as high as they are and cap rates as high as they are. So we're not doing much in the way of multifamily. We are doing some, but not most deals don't work. But we're getting really inundated with requests for lot development financing for a number of reasons. It's a very the builders are very concerned that because of a slowdown in development in 2022 and 2023, they're not going to have enough lots to answer the market in 25 and 26 and 27. It takes a year and a half to 2 years to develop lots for a new project. So they have a very strong appetite right now to sign up for new lots in new projects. So that obviously drives the market. So we are getting a lot of requests for lot development financing, and that is good because it allows us to put money to work, and we don't have as much right now on the, as I said, on the multifamily. We're doing some retail loans, but we're very selective about what we do. We're not going to start making office loans and get into that mess. So to say there's a line of potential borrowers is not too far off for as it relates to lot development right now. Our borrowers that we've done business with have a number of projects lined up for us to do, and as I said, we're focusing on some more along the East Coast right now. We've got some new relationships in the Carolinas, and that's a very active market. So we're doing more business in North and South Carolina as well.
Yeah. So back to didn't answer that question yet, but if somebody's looking for regular income and they're investing in your debt on the debt side, rates are coming down. We're seeing rates come down anyway. What's a reasonable expectation over time for somebody on the debt side who's looking, maybe a GIC investor who's saying, I can't really get along with 4%. What's kind of that comfort zone that you think investors might be able to achieve?
Depending on what the parameters of the fund are, we feel comfortable in the 7 to 8% range.
Mm-hmm.
Where that for as the net for our investors,
Mm-hmm.
and it may be higher, but I don't think it'll be lower than that. And our prime trust fund, which does only first liens and it's only 50% loan to value, and so it's a very low risk fund, lowest risk fund, maybe more like 6%, 5-6%, but the other funds should be able to get 7 to 8%. Now interest rates are going down, but we don't. We've put floors under all of our loans.
Mm-hmm.
We about 4 or 5 years ago, we shifted from fixed rate loans to floating rate loans, which was very beneficial as rates were going up. Now rates are coming down, so we still have floating rate loans. We may return to the days of fixed rate, I don't know, but we put floors under them. So if mm-hmm. if prime rate go, and we base our rates on prime, not on SOFR. And so if prime rates go down to 4% again or whatever, our rates won't fall that much, and because we'll be able to maintain. We feel we'll be able to maintain that
7 to 8, and then if you look at the equity side on the Trez opportunity side, where you're more doing equity, what are anticipated returns on lot development?
Well, on Fund 8, we are projecting a 20% IRR over a 7-year period. So that's with a multiple of over 2 on and we think that's
reasonable.
a reasonable return and relatively conservative, probably very conservative.
Yeah. Okay. So, John, that's up against the clock a little bit. I do appreciate your insights today. One of the things I know about you is you know your market. And I've always been impressed with the quality of your borrowers, some of the people that I've met, the relationships you have with them, and how you work hand in hand to create a win-win relationship.
Yeah, it needs to be. It needs to be win-win. Like I said, we want to do business with people that we have experience with, and if if a borrower doesn't trust us, then they're not going to come back to us, and if we don't trust them, we're not going to want to do business with them. So I think people look at things as this is a relationship business. It really is, and having good relationships bears a lot of fruit, not just in making somebody a loan, but having somebody you can talk to and get information from, and other referrals and whatnot. So, and that's the people that we have here in my office in Dallas have all been here for quite a while, and we have been in the market for quite a while. If you add it up, my God, we must have 150, 200 years of experience in the market. So among collectively, myself alone, I got over 40 years.
Plus another 100 years for Morley.
Oh, boy, that's right.
Yeah, you could tack that one on there.
Bob, I should say one thing. I should have mentioned this earlier. Our loss ratio on lot development loans we've lost on one loan. We lost $50,000. We've made 266 loans, over $5 billion in lending. Now that 50,000 over 5 billion is, I don't know how many zeros you got right of the decimal point, but there's a lot of them before you get that to a digit. So anyway, it's been a very successful business for us and our investors, and we expect that to continue.
Before making any investment decisions, it is crucial to consult a financial professional advisor to determine suitability. Full disclaimers are available on privatedebtandequity.ca. John, thanks so much for joining us today. It's been a pleasure.
Thank you, Bob. Look forward to seeing you soon. Go Bills.
Go Bills, yeah. I haven't told you that in 1971, I picked the Miami Dolphins to make the playoffs after a 4-10 record. And they made the playoffs next year and went undefeated.
Yeah, that was their year,
in 72. So I've kind of been a Dolphin fan versus a Bills fan. So
well, all right, I'll forgive you. You can't help yourself.
I know. Anyway, thanks for tuning in to my Private Network podcast. Be sure to subscribe, tell your friends. Thank you.